This is Dustin with Dustin's Dollars. Today, I'm going to be talking about Marathon Digital Holdings. They are a Bitcoin miner. Ticker is MARA, or otherwise known as MARA. Today, I'm going to just be giving an overview of the company. I'm going to go through some, recent events and some other, what do I want to say? Some other things that they've announced recently. And then I'm going to go through a model that I have for the next 2 years of the company and sort of look out, a couple years and see what the valuation could be. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently do not hold any meaningful position in Mara. So this video should be for entertainment purposes only because I can be wrong about everything they say in this video. You need to do your own research before making any investment decisions. All right, so Marathon Digital Holdings, I'm just going to call it Mara in this video. By the way, shout out to DEFCON2, he or she, I guess I'm not sure, gave me a couple pointers for this company and, piqued my interest a little bit. Although I've been looking through all the Bitcoin miners, I just want to give a shout out to that person. Thanks for a couple of the pointers. Now, they are a Bitcoin miner, right? I'm not going to go into details on Bitcoin mining. I have a video from a month or so ago called An Investor's Guide to Bitcoin Mining or Bitcoin Miners. And if you're not familiar, you should probably go and watch that if you want to learn just about Bitcoin miners in general. So I'm going to assume some basic familiarity, and I'm going to talk specifically about Marathon Digital. And this right here is from their annual report. This shows, a rough overview of their facilities that they have or where they have their hash rate located. This shows, it might be a little small for you to see. I don't know if I can zoom in too much more before it. It doesn't like to zoom in the image like that on their 10K, but you can see they've got a couple facilities in the United States and a couple different states across, a couple in Texas, some in, I think, North Dakota, and then a couple more. And then they have some in, I think, the UAE and Paraguay, where they have this other facility I'm going to mention in a couple minutes. But the point here is they've got a number of facilities, and they're fairly large miner, right? This table here gives you a more specific overview and shows at the end of the year, they had 24.7 exahashes per second worth of, mining capacity deployed. You can see that there are some of their deployments are much, much larger than others, right? You can see there's this facility in Texas at 7.7, this facility in North Dakota, 7.8, goes all the way down to some, their smallest facility in Paraguay is, currently 0.2 exahashes. I think they are planning to either, I'm not sure if it's expanding that or have another facility in Paraguay that's going to be larger. And they did mention that on the earnings call, but they are growing. And, they historically actually didn't own their facilities. And most of these facilities, I say they're their facilities, but actually this is where their miners are located. I do not believe they own very much of this at all. I'm actually not sure which of these they own. They did say they own 3% of their facilities. I didn't end up checking because it's such a small amount. So most of these are hosted facilities. Marathon Digital owns the machines, the actual miners, and they've got them installed there and they're operating this. Now, that is about to change because they did acquire they just announced the closing of this in January. They acquired 2 sites. Let me see if I can zoom in. You can read the text a little better. 2 operational sites. There were a total of 390 megawatts. And so that's quite a bit, right? This was not quite a doubling of their overall capacity, but it was an increase of, 40% or so. If I was going to, roughly estimate the math, I think that specifically I've got it written down. I suppose it was from 584 megawatts of capacity to 910 megawatts of capacity. So that's a pretty big jump. And this gives them a lot more capacity where they can put miners, and it's also strategically important for them because now they have some facilities that they own themselves. They can control the cost structure, 100%. And this is, hey, DEFCON2, sorry, thanks for hopping on the stream. You're totally welcome. This was it was a joy to learn about the company. And so with this new facility, it is, as I said, over the next 18 to 24 months, they're going to actually, well, sorry, that's not necessarily referring to this facility, but they said it's going to take, a year or two. I don't remember. I'm not sure if they gave an exact timeline, but right now, a lot of these facilities are leased. Marathon Digital is a current customer of this, facility, of this 390 megawatts of, operational capacity. I think they had a contract for about 60 megawatts worth of power of their machines hosted there. And so that remaining about 330 megawatts is, there are currently contracts with other folks who have their miners in these facilities. And over time, as those, leases run out, Marathon has stated their intent is to not renew those leases and instead to, have those folks take their machines away, take them home, and then Marathon is going to install their own machines there. So this gives them some space to expand as they are, purchasing new miners and need somewhere to put them. So that I think is really the, interesting piece about this, right, is that they actually bought more operational capacity now. They're making money from this, presumably, by taking over some of those leases and being, being a hosting provider for other companies. But then as those leases run out, they're going to, put their own machines there and actually utilize that capacity for themselves. And that's how they're going to support their plans. And I think if I do the rough math, they can, I think, support almost all of their 2024 expansion plans just with this particular facility or these two facilities, I guess. And I'll go through some of the numbers in a bit when I go through my my model, my spreadsheet. But I think the other thing that is really useful here, I alluded to it, is that's where they can reduce their cost of operations. Sort of benefit from both power cost and cost of operations here. And on the call, I believe they said, historically they end up getting about 6 cents in terms of power costs, and I think they can reduce that to below 5 cents for power by managing it themselves. And then there's also the cost of actual operation, right? The actual managing and running the facility itself. And I think they're going to get another, I want to say it's on the order of, half a cent to a cent per kilowatt hour, if you want to really do the math out to that level, in terms of benefit. And so overall, I think this is like I've probably got the numbers here somewhere. Sorry, I have 10 pages of notes that I took. But I want to say, 23% reduction operating costs from about 7.4 cents to about 5.75 cents at the midpoint of their estimates. So overall, 23% reduction in the costs if they have their machines at this facility that they own rather than one where they are, hosted. And so that is going to be really important for them. They've even said they are on the hunt. They're on the lookout for more facilities if they can find them. Because they have pretty large expansion plans. I don't know if I mentioned that yet, but they do plan to grow their hash rate from 24.7 exahashes, where they were at the end of 2023. They plan to grow that up to a range of 35 to 37 exahashes per second by the end of 2024, and then by the end of 2025, they want to go all the way to 50 exahashes per second. So almost doubling, from where they were at the end of 2023 in 2 years' time. And so that will be, quite a large growth. And one of the things that I really got when I was looking through, when I was doing the research on Mara, is, listening to the earnings calls and reading through some of their literature. They are laser focused on actually being not just as large as they can and not having as much hash rate as they can, but actually being, efficient. And they repeated multiple times in the earnings call, and you can see it through in some of the decisions they made about being in that sort of bottom quartile of, cost to actually mine Bitcoin. And this makes sense, right? If you view Bitcoin similarly to how you would view any other commodity, right? View Bitcoin production or Bitcoin mining the same as you would view like oil production. If it costs you more than most everybody else to produce oil, when the oil price drops, everybody else is going to continue producing and they're going to still be making a profit. And could drop below your break-even price, and now you no longer can produce oil and make a profit. Right? You can produce oil, but you're actually losing money, and that's what happens in a commoditized business. And in particular, because of the scarcity of Bitcoin and the reducing over time block rewards every 4 years, this is really something that miners have to get right, or else they're going to go out of business over time, right? Because the rewards to them in Bitcoin terms are going to get lower and lower. There's only so much to go around. And, as other players are able to scale up at a lower, cost basis to produce Bitcoin, that sort of pushes the average for the industry down. And so Mara is really focused on making sure that they are low cost. They are already at, an efficiency rate of, let me see if I got the actual, if it's in this. So that's, here's February. I think did they report their joules per terahash? No, they don't. I have their stated number from the end of the year here. I'm not going to go through the model here, but they were at 24.5 joules per terahash at the end, or I think that was at the end of the year. And this is, fairly low in terms of industry average. And I think their plan by the end of, sorry, I put in my model here. I sort of made the numbers work out. I think by the end of 2024, beginning of 2025, they plan to be down to about 21.5 joules per terahash in terms of efficiency. If you're not familiar with that as a measure of efficiency for Bitcoin miners, joules is a measure of energy. Terahash is how much compute power they have, and so this is really how much energy does it take to do a certain number of calculations, to do a certain number of compute, which then turns into Bitcoin rewards eventually. And so a lower number there is better because you're using less energy as an input in order to do the same amount of compute. So again, this is an overview of their operations, and they do have these plans to grow. And sort of this owned facility, right? This acquisition that they did, and potentially more acquisitions to acquire more facilities that they can own the whole stack and reduce the cost there. That's part of their strategy to become a lower cost Bitcoin miner. There are some other things in terms of just they have better machines right now, right? These machines are newer, right? These are not the bleeding edge machines, but these are, what they have currently deployed are on the lower side in terms of industry average. And then they are planning to deploy even more efficient machines I'm going to talk about in a second. And then another thing that they actually have in terms of, being more efficient, they have some bespoke projects, right? Where they have this project I mentioned in Paraguay, where I think they said they're going to have, about 1.1 exahash per second of capacity they intend to deploy there at some stranded hydropower, right? Where today there's the capacity to generate all this power, but it's not being fully utilized. And so they are able to just install the Bitcoin miners, presumably get a very, very low rate on energy there because it's stranded. And, they've got another pilot project they're doing with someone who operates landfills. And these landfills, I guess, produce gas. And so they are actually going to just utilize that gas right on the spot to then, burn it, convert it into electricity, and use that to mine Bitcoin. And this is, again, I think, a very, very low cost source of electricity that historically was fairly stranded, right? Nobody was really able to utilize this very efficiently. That gas is coming off of the trash and landfills. And so these are some interesting projects. There was a lot more alluded to in the earnings call, where they are looking at actually some other operations where folks would traditionally just be producing heat. And the one they mentioned, there's some industrial processes. One that they called out specifically was something like heating up water for shrimp production. And this is one where historically they're just wasting the electricity, or they're just wasting electricity to create heat. And they could, Bitcoin mining actually produces heat, but it does something productive with that electricity. And so they've talked about being able to integrate into some of those processes. They've talked about even heating buildings with somehow some sort of a little Bitcoin mining pod. And I don't really have a link to it here. Maybe I could pull it up real quick. Bitcoin mining hot tub. So this was something that somebody, I'm not going to open up an actual YouTube video, but I was just looking for an image here. This is an example of what somebody has done. Let me see if I can just find an image of there's a lot of instructions here, but you can see the final. Somebody built a hot tub where they ran the actual, piping of the water that's being pumped out of the hot tub and into this little unit that has Bitcoin miners in there. And it's, there you can sort of see how it's piped in there, and, they've got their Bitcoin miners in there. It's producing the heat. It's being, radiated off into the water, and they actually have an operating hot tub that is being heated by Bitcoin miners, right? And so this is, that same concept could work for, any building that needs to be heated if it was, packaged properly, for lack of a better term, having the right design and engineering in place so that this is a reasonable process. It's a very interesting thought, and Marathon is fairly public about saying that they're looking into these things, and so those would really be very, very low costs of energy for them in terms of mining. And so it remains to be seen exactly what that's going to turn into, but that is very, very interesting, and as a business model, could very, very what do I say, forget being just the bottom quartile of producers. You could be at the very bottom if you're getting effectively free energy, from some of these, or even getting paid to actually do the mining yourself, right? Because you actually generate heat, and if you can generate the heat at a lower cost than what folks were historically paying, I mean, that's profitable. So it's plausible that you could actually get paid for that. So DEFCON 2 says, yeah, you got it. Use the heat from Bitcoin miners serve a function and cover your costs. Exactly. So that's really interesting, and it's sort of, that is one thing that I saw with Marathon that I didn't see from a couple of the other Bitcoin miners that I was doing some research into. Is, Marathon is past the point in their business where they're just purchasing machines, putting them in facilities, and operating just standard data centers and letting it go. Right? They are clearly trying to innovate. And I mentioned, maybe I didn't mention, maybe I'm just thinking my own notes here. They are diversified, across states and across countries and power sources, and they're also diversified a little bit across sources of ASICs. And now they talk about some of these. These are, I believe, what are they? Bitmain, I think it is a company that makes the S19s, S21s, all these, lots of the Bitcoin miners that most people are familiar with. But Marathon actually has investments and co-owns, and the CEO sits on the board of this company, Auradine. And this is, a new, I think, US-based Bitcoin mining machine producer, right? So they're not operating these. These are actually designing and producing the machines. These are some of their products. And Marathon has options with this company and orders into this company to actually purchase some of these, and they have options that don't expire and don't put any obligation on Marathon, but they have sort of right of first refusal for these products as they're coming out, because these are brand new, bleeding edge. These are, I think, some of the most efficient machines that I have seen, right? Air-cooled miner at 16 joules per terahash is very efficient. The one thing that I could not find anywhere on this website or anywhere on the internet publicly is what the cost of these is going to be. Now, I have to imagine that the cost of these is something else that they took into account. Marathon has put money into this company. They've invested in them, and without a similar product in terms of pricing to Bitmain systems, they're going to tell them to go back to the drawing board, right? So presumably these are at a comparable cost. I kind of use $15 per terahash in all of my calculations. I have my model that I go through in a couple minutes. I think that compares just slightly under the cost for the Bitmain, the most recent Bitmain. I think the CleanSpark, got this large contract at $16 per terahash through Bitmain. And I have to imagine that Auradine is willing to give even thinner profit margins to Marathon because they actually invest in the company, sit on the board, right? So there's probably some pretty good dealings going on there between those companies. That's why I sort of model at a slightly lower price, and that's only like 5% off, something like that. So, okay, DEFCON2 says the moat with Auradine is dual phase immersion cooling machines, which are tuned to Mara's liking, coming online later this year. Yeah, exactly, right. And so that's like the big thing here is, it seems to be that Marathon has been, involved in the process of designing these, right? These are not just off the shelf products like all the Bitmain machines are that multiple miners use, and I can go purchase one myself, and it's just a standard Bitcoin mining machine. This is one that Marathon has gotten built to their specifications, and it's probably have helped in the design a little bit. Again, I don't know the details there. Thank you for calling that out. Like, I actually don't know enough about the dual phase immersion. I'm not quite sure what that means. I'll have to do some more research on that for myself. I heard them say that same thing. I can't remember if it was on the earnings call or in another interview with the CEO, Fred Thiel, but they did say those words. And so yeah, that is really cool that they have this ability. And I think on the flip side, this turns into a bit of a moat for them, right? So you say the moat with Auradine, and so yes, that's both the moat for Auradine, but also I think because of the relationship with Marathon, it's not very clear, but it seems like Marathon might have sort of be their sole customer, at least for the next year or two, being able to be the only ones who can get these machines, right? So if Marathon is taking all of the machines that Auradine is able to produce, and that becomes a moat for Marathon because they now have these machines that are just plain more efficient than what everyone else has access to. And so I think that's again sort of builds my starting to get, as I did this research, and honestly I did a lot of it over yesterday and today, so I haven't been able to frankly trade, but I do intend to buy some, to take some position in Marathon, a long position, for the interest of full disclosure. I don't have it right now, but I do intend to this probably soon, because I'm seeing a lot of things that differentiate Marathon from other Bitcoin miners, where Marathon has some, they're not huge, right? They are, someone else could overcome them, but they certainly have at least temporary or short-term moats, I would say, in terms of Bitcoin miner. I think that's actually a pretty good a pretty good case for a Bitcoin miner if you like Bitcoin itself, as I do. So yeah, DEFCON 2 says yes, Mara was involved in the design of the dual phase immersion machine. Yep, makes sense. So one of the things here, and you touched on it, right, where they were involved in the design of the machine here, is Marathon also operates their own pool and they have their own stack top to bottom in terms of the software. And so having these machines gives them, they talked about this on the, again, sometime I heard the CEO talking that these machines are also going to give them more ability to control things than what the standard Bitmain machines give them. So they can, overclock, underclock these at times that are advantageous for them. They can turn them off, quickly turn them back on, in terms of, I don't know the details there, right? That they didn't give a full insight in that, and clearly some of that's going to be their trade secrets. But I can speculate here and say it'd be things like, if I'm at, if I have a surge of, or let's say like if I have, more blocks where the fees are higher, I could probably overclock all my machines and say, hey, increase my chances of actually finding this block or the next block or the next block, because as of right now, fees are higher, right? And you could actually, if they're getting overheated and fees are back down to normal levels, you could say, well, let's bring them back down, let's turn some off, let's reduce the reduce our power consumption right now when fees are lower, let things cool off a little bit. There's a lot that you can do in terms of micromanaging that. I'm sure they have way more insight into those things, but the point is that they made is they have more control with these machines, and so because they also operate their own pool, they can actually control this all the way down to the to the hardware and make better decisions. Sort of have that vertical integration. That's something we see in multiple industries, where that vertical integration enables some of these companies to do things that lots of their competitors just plain can't do. And so I think, again, as I was looking into Marathon, they really seem to be the leader in a lot of this. They seem to be more diversified, I would really say, right? Where there's a bunch of risks that Bitcoin miners have, and they've done a lot of work across their entire business to really insulate themselves from as many of those risks as they can. And so I think that's it's a really big plus in terms, personally, when I'm looking at Marathon. All right, so let me get into. Yeah, I'm going to talk a little bit about just some of their most recent announcements. I'm going to touch on these very briefly before I then go through, their financials and sort of my walkthrough of their model here. Two of those I'm going to touch on. I think Auradine is one of them, although it's sort of a separate company, but clearly they were involved. I think they also had two recent announcements. One was this Slipstream, and Slipstream, as I'm reading through it, is basically. Let me try to explain it briefly. Bitcoin transactions, there's sort of a couple, there's like a standard Bitcoin transaction, which is, I'm taking some inputs, right? If Bitcoin terminology, unspent transaction outputs, basically Bitcoin that is somebody has, and then they're going to take some of that and pay it to different people now, right? So you might pay it from this person to that person, or maybe it's split, from 5 Bitcoins. Now I'm paying, 3 to this person, 2 to that person. It's a very simplistic process. But in reality, all these Bitcoin transactions, beneath them, there's actually a script portion, right? Where that's kind of the point, if you've ever heard somebody describe Bitcoin as being programmable money, every Bitcoin transaction has a script embedded within it, which is what describes what the actual transaction is. And so lots of payments, that's just one type of transaction you could do, right? There's actually a full scripting language where you can do many different types of transactions. It just so happens that, again, most of the time you're just paying people or moving money from here, Bitcoin from here to there. But there's a lot more you can do with it. Not going to go into details, but there's a lot that folks have done recently with, ordinals and inscriptions and even more things there, where they're not just moving Bitcoin from here to there, right? They're doing other stuff. They're actually putting, effectively images or arbitrary data in Bitcoin transactions. And I mean, to be fair, Bitcoin script could enable even more things, right? And so the point is, there are some of these transactions that are not standard. There's also some controversy within the Bitcoin space where some folks want to sort of censor these, right? They don't want Bitcoin used for some of these other things. They just want Bitcoin to be for, payments. I think effectively moving Bitcoin around, block space on the Bitcoin blockchain is already, scarce enough that they say, we don't even have enough block space to do all the payment transactions that we'll want to do, as Bitcoin really adoption grows. And so there's a lot of controversy. There's some folks where these transactions are not actually forwarded on, and there's even more things. And so what this is all getting to what Marathon launched, and Marathon basically said, you know what, we are going to be agnostic. We don't care. If as long as these are valid Bitcoin scripts and valid Bitcoin transactions, we are happy to include these in a block, right? We are happy to mine them and take the fees associated with those. And so what Marathon gave them, and so part of the problem here is, let's say I have one of these non-standard transactions and I want it to get mined. I want it to be a part of the Bitcoin blockchain. I have to get it to a miner that's going to actually mine that. And historically, you just kind of, Bitcoin had a protocol where you could send it off to nodes, and hopefully they would then forward on to more people, and hopefully, sooner or later, as it's been forwarded on, everybody or substantially everybody knows about it, and there's somebody who's going to then mine it. And if there are some people who aren't mining these things or aren't set up to actually recognize that these are even valid transactions, maybe they have fairly conservative limits on what they will validate and say that this is a valid Bitcoin transaction. I will attempt to include in one of the blocks that I'm mining. Then you had no good way to actually get your transaction to a miner that would mine your transaction. And so what Marathon did is they launched this thing, they called it Slipstream, and they said, hey, you can submit a transaction to us as long as it's valid. It's a valid Bitcoin script, right? It's a valid Bitcoin transaction. And as long as your fee is sufficient for us, we will happily take your transaction. We'll happily put it into a block. And this, I think, is interesting for Marathon because there's really no downside to them. I think, as long as they are actually ensuring that these are valid Bitcoin transactions and the other folks are not going to actually, reject the blocks that they produce. And again, I have to trust that Marathon knows what they're doing in terms of those respects. There's kind of no downside to them because people are going to submit transactions to them and presumably submit fees that they are happy with, accepting. The Marathon's happy to take that amount of money from them. And so, as many people submit transactions to them, I think this is probably, additional fees that Marathon is going to be able to collect because they have this service that other miners will not. And, the longer this goes on where other miners may not be, entertaining these transactions, and if they get directly submitted to Marathon, this is really, really interesting because now this is, again, sort of another small moat that Marathon has, at least until, other mining pools have a similar, submission process where Marathon is going to say, Marathon is going to sort of suck up and get all those transactions. So all these transactions, that lets Marathon say, hey, the fees that we require for you are going to be, 10% higher, 20% higher, 50% higher than what the standard, Bitcoin transaction fees are at the current moment. Who knows how they're going to manage that? And I don't think this is quite up yet. But over time, I think this, it can't hurt them, right? Worst case, nobody gives them transactions and Marathon continues just mining all the normal transactions that everybody else does. But best case, every transaction that they get from Slipstream is presumably going to have, higher fees and is going to be pretty interesting here where, they are getting that additional revenue. Sorry, I see there's some comments. DEFCON 2 says, yes, Slipstream will handle large, complex, non-standard transactions, but they're still valid. Yes. And yes, and Mara collects a higher fee, exactly. And for ordinals, but ultimately also beneficial for financial institutions to come on board, in my opinion. Yeah, I think that's another one here, right, where they... I was reading through the details of Slipstream, and this was... my initial assumption about what this was when I read just the headline and sort of the one-sentence description was not quite what they described it as, but I think they alluded to it here. And really, what I thought it was going to be is some sort of a service to say, hey, you can pay me pay Marathon, for your block, for a transaction or for a block ahead of time. Because this is another thing that folks have talked about in terms of, let's say I want to, I don't want to go too far in the technical details, but let's say I know that I'm going to want to do a transaction in the future. And if I'm doing it now, I can just submit it and hopefully it will get mined and I can react to whether it gets mined or not. Meaning if my fee is high enough to actually for a miner to accept it and put it into a block. Because if everybody else is paying higher fees for their transactions, then no one's going to want to mine my transaction. But if I want to do a transaction, let's say a month from now or a year from now. Let's say I'm trying to do, I want to hand down to Bitcoin to my kids, and I want to do a transaction 20 years from now. And I say, hey, when my kids turn, 20 or 30 or something, or 18, right? I want to make sure that I can, send them a Bitcoin. I don't want them before that point, but I want to do it then. And who knows what fees will be in 10 years? Let's say your kid's 8, you want to send them a Bitcoin when they're 18 years old. Who knows? And again, forget about the fact that maybe you could do this through some time locks and other things on chain, but like, if you want to do a transaction 10 years from now, you have no idea what the fees are going to be. The fees could be 100 times what they are today. And, now all of a sudden you might not be able to do that. And so I think that's maybe, a bit of an extreme example, to go out 10 years. But let's say you want to do one a month from now, because as you mentioned, you're a financial institution. You have some valid reason why you want to do something today and something's going to happen in a month from now. You're going to, close out something else and you're going to settle in Bitcoin. But you want to lock in your fees to know that, hey, when I actually do this transaction, it's going to cost me exactly this amount, no more, no less, or at least to have an upper bound on that, And so I think there's another thing that might happen through Slipstream, and they did allude to somewhere, if I recall correctly, where you could potentially pay your fee upfront and have Marathon assure you that, yes, we accept your fee right now. We will gladly put this transaction into a block when you're ready for us to do so. So effectively recognizing that not only is the service of doing the Bitcoin mining a service, another effectively product that they offer is block space itself, right? And so they can give someone assurance that I can give you block space a day from now, a week from now, a year from now, if you pay me a fee that I'm happy with at the moment to accept. And again, that I think is something where, in terms of the investment case for Marathon, it only provides upside from what they're already doing, right? If nobody ends up using that, or they don't end up offering what I described as a product, and nobody ends up using Slipstream, they really don't lose much. They continue to mine Bitcoin as they are today, but to the degree that they're able to get incremental, fees and revenue from this, this is only just more and more revenue on top of what they're able to already do. So there's basically no downside for them to do this, other than sort of the R&D, costs that they had to set this service up. And I think it's not quite set up yet. If you click through to the actual Slipstream, website, it says it's coming soon, but presumably they're going to do this fairly quickly. All right, DEFCON 2 says Slipstream should keep fees very low in the main mempool, since they will funnel all higher fees towards them in theory. Yeah, so that's interesting. In practice, though, I would say, if higher fees are going to Marathon, and that's a certain portion of the, the hash rate that is, or certain, not just the hash rate, but a certain portion of block space that is only for these higher fees, it's sort of hiding the fact that the fees are actually higher than what the mempool shows, right? But I think in general, like, you're right that would be the net effect. So, anyways. Yeah, no, absolutely. Low risk, but big upside if it takes off. 100%. Totally. And this is one of the things where actually, I'll be honest, I've known about Marathon for quite a while, and I never really did the research. And now after doing the research the past couple of days, it's a lot more interesting than what I thought, and a lot more interesting than some of the other Bitcoin miners. So it's cool. All right, moving on. One other thing that they announced, and this one's going to be fairly quick, because to be honest, they don't have enough details for me to really evaluate this one. But they did announce this sort of layer 2 network for Bitcoin, side chains. And this is interesting. They did actually have wasn't even a white paper, that a light paper. I think this is another similar thing to Slipstream, in not at all similar to the product, right? What this is they're able to actually make, I'm not going to go too much detail, but they're able to, instead of doing things on the main Bitcoin blockchain, they're able to take some of that Bitcoin, sort of lock it, send it over to this other side chain, and then still use Bitcoin as the token that you're using for your transactions. But they're able to do more things on this other chain that they will also be mining. And then, at some point, if you want to actually sort of take that Bitcoin and send it back to the main chain, you can do it by sort of deleting, the term is burning, right? So burning the Bitcoin on this side chain, and then you can sort of unlock it back on the main Bitcoin blockchain layer. But the point is, you can now go on the side chain and do things to whatever you want to do, right? They can sort of define the rules on these side chains. And again, I'm not going to go into too much details because there wasn't enough in this, paper. I read through the whole thing. I am a software engineer. I have, some understanding. I'm not I don't work in the crypto space, but I've followed along. I have enough understanding of this to have some insight. There weren't a lot of details here, so I think I'm still waiting to find out more. But from an investor standpoint, I think there's two things that came at us. One is, and I wasn't really familiar with this too much, but they talked about using merge mining, which if I understand correctly, again, this is I don't know the details here, but if I understand correctly, they're basically still just doing Bitcoin mining, but they're able to actually use that same proof of work, both for their standard Bitcoin mining, but also for these side chains. I thought that was interesting, where they're kind of doing roughly the same stuff that they're already doing, but that they might get some amount of, Bitcoin rewards through this side chain because of, again, mining and actually operating the side chain. So I think that's interesting. I just don't know enough yet to have a really strong opinion on it. But I think, as I was alluding to, this is similar to Slipstream because Marathon, if it doesn't take off, the risk to them is fairly low, right? The additional cost to actually do this, there was some R&D, and they're going to have presumably continued R&D to get this up and running. I don't think this is operating quite yet. But once this is up and running, I don't think there's going to be a lot of, there's not a lot of hardware costs behind this, right? This is just software that they have to write and get it going. And I don't think they're putting a lot of more hash rate behind this, right? I think they said they're doing more of validation rather than, proof of work for this. So it is interesting, again, where if this does gain adoption, this is strictly additional upside for them because they don't really have to do a lot more work once the R&D is over. They're just doing the same proof of work, the same Bitcoin mining that they are, and they could potentially gather additional fees from this, from these side chains on this sort of Anduro network. So that I think is similar. DEFCON 2 says, where did you get this white paper on Anduro? It is listed right from the website. Sorry, so this was their PR, their announcement. Click through to the actual Anduro website, and I think that takes you here to anduro.io. And then there is a link right on the top right for the light paper. So that is how I got that. Hopefully you're able to follow that along and find it for yourself. Feel free to read over it. Again, it's skimpy on the details. I've read other white papers that were very, very detailed. This one is not it. It sort of talks more in terms of high level principles and how we'd like it to work and how the incentives are going to work, and don't really go through as many technical details as I would. I wouldn't as a software engineer, I would not say this is a design document. It's more of a vision document, if that makes any sense to you. So, all right, I just want to talk through that because, again, this is, I think, really interesting because of two things, right? Number one, because Marathon is pushing the envelope, right? They are innovating. And number two, this is something that fits, it's a one small additional step for them where they do the R&D, they don't have to do a whole lot else past that. So their ongoing operational cost for this is going to be negligible as far as I understand it, but there is some upside to them, right? And so if it doesn't work out, whatever, it doesn't really hurt them that much. They burned a little bit of R&D spend, not the end of the world. But if it does, gain adoption, I listened to there's a good podcast recently as I was doing this research where they had a couple people from Marathon that talked about it a little bit, and there still wasn't enough technical detail for me to really feel confident, but they did talk a little bit where they are getting some initial interest from this because, Marathon is such a large presence, and Marathon actually has a credible way to say, hey, we can support this sidechain. We have the hash rate, right? And so, again, this is only potential upside for them. So Anduro is also, sorry, this is a comment from DEFCON 2. It says, Anduro also is meant increase Bitcoin adoption with developers driving its growth. Yes, exactly. And that's part of the other thing here. I guess I've got it right here where I wasn't, didn't do that intentionally, but they've said a lot of blockchain and crypto developers are, I think like 50% or more, are familiar with what Ethereum does, right? How they have things set up. And Bitcoin is totally different. Bitcoin is a different scripting language. It is a different model. And one of the things they said here that, again, I don't really understand, but one of the things that they're planning to do is have an Ethereum compatible, meaning like programming on this sidechain will be similar to programming on Ethereum, a compatible sidechain with smart contract programmability. But again, this is using Bitcoin as the backing asset behind the blockchain itself. So that has the advantages, some of the advantages of Bitcoin, not all of them, right? Because it's not layer one Bitcoin, but you have some of that same scarcity and security that you have from Bitcoin itself that does come along the sidechain. So it gets a little complex. You can debate certain aspects of that, but it is interesting. But to your point, yes, this is giving a way for folks who are familiar with how to program, with the Ethereum stuff to actually work on a Bitcoin-backed blockchain in a similar manner. So, all right, let me go through to my walkthrough of my model here. And, as I just talked about some of the innovative things that Marathon is doing, this takes into account none of that, right? So if there's additional upside in terms of how much fees they can collect from, doing this sort of merge mining and on Anduro, and some of the stuff they can get from, the Slipstream, higher fee transactions that go just directly to Marathon, none of that is baked into this model. Now, I did take into account the fact that they are very, very much intending to get these Auradine machines that are more efficient than what else is on the market, and so that comes into this over time. So let me walk through this model real quick. I did this quarter by quarter, going out through 2024 and 2025. Sort of the top section here, I have what are their starting stats for the quarter, with the exception of Q1, because we actually have some of the stats as of the end of February from the company. They actually do these monthly reports, which is really, really interesting. This is from December. This is from February. So they've already released this. They released it just a couple days ago. Of here's what we did in February. How much Bitcoin did we produce? How much cash and Bitcoin we hold on the balance sheet. I think it's super interesting that they are reporting these numbers as of the end of February. So this almost in real time. How much Bitcoin are they holding on their balance sheet? How much cash do they have? They do not report, as far as I can tell in here, they do not report their number of shares outstanding. So we don't know if they're diluting to actually get some of this cash. They don't report all of their operational expenses and such, but they do give an overview of their balance sheet and their Bitcoin production, which is pretty nice, better than what anybody else does in most industries. So starting stats here, I have what's their starting share count, how much cash they have, how much Bitcoin they have on the balance sheet, what is their current how much mining capacity they currently have in terms of what is energized. I didn't really go into what they have installed versus what they have energized. I'm just going to go through what they have energized here, and then I look at what is the current efficiency of their fleet. That actually, sorry, this was not the number I meant for that to be like 27. Sorry, I was tweaking with some numbers, something before this. That was what I meant to be there. So, but then I look at what is the efficiency of their fleet in terms of joules per terahash, and then what percent of their fleet is self-operated. And I put this here because this is something that I think will go up over time, and their operational costs and their power costs will go down, for all of these facilities that are self-operated versus the ones that are not. So, and then I also looked at what is their capability of their facilities in terms of what do they have to actually install machines in. And this is a number where this includes both hosted and self-operated. That's why this percent here is sort of a percent of how many of this megawatts do they actually operate themselves. And then in terms of their mining, I looked at from their hash rate between the average between their beginning and ending hash rate for the quarter. What is that on average? What percent of that is operational? I'm going to talk about this for a second. But they're not going to be at 100% hash rate that's installed and energized actually operating all the time. But I think let me talk about this just for a moment because it's relevant. So they had some recent issues at some of their facilities that they do not own, that they are hosted. And they actually had a pretty bad January, pretty bad February in terms of what percent was operational. If you look at February here, you can see they had 28.7 energized hash. I did mean to put 29 there. Sorry, where was I changing the numbers? Let me fix that real quick. Sorry, I don't know why I second guessed myself live on the stream. But if you look at February, they said we have 28.7 energized, but we only had 17.6 operational on average for the quarter. You know, they started at about 25, they ended about 28.7, you know, and so to have only 17.6 operational, that's pretty bad. They did talk about this in the call. I think that they have fixed a lot of these issues. You know, there were some unexpected power events that happened, stuff went down, so they just really couldn't operate their some of their facilities. I believe they said a lot of that just got addressed right at the very end of February, so March should look better. And I think they were still fixing one other issue, so hopefully that will happen by the end of March, and then hopefully Q2 will look better. And so that's why if you look at these numbers in terms of what percent is, you know, operational, then, you know, even if, like, things should look better, right? So it was, let's call it 75% in, you know, in Q1, but then Q2 and onwards, I'm expecting this to be more like 95, 98%. You know, and over time, this really should get up to 99% for most time. You know, they can't really forecast when you have unforeseen events, but as they are more diversified and they are owning more of their own facilities and can manage these things, you know, preventative maintenance such themselves, you know, presumably they can get to pretty high, you know, uptime percents. DEFCON 2 says 2 facilities owned by Applied Digital had outages. Yes, exactly. And I don't know, you know, in the industry, a lot of times you have some sort of an SLO, a service level objective, and a service level agreement that actually says, hey, we're going to give you this percent of uptime. And, you know, they didn't really talk about it on the call. Lots of times when that's the case, you know, you have some contractual obligations from the company, you get some recourse in terms of those, but it's hard to say what their contracts actually look like. So, and DEFCON 2 says they are diluting, unfortunately, but if they can reach zero cost mining, it'll be worth it. As I always say, zero cost mining or bust, and that goes for all the miners. Yeah. Yes, they are diluting. Sorry, I need a drink. Yeah, absolutely. And, you know, dilution is not, it's not bad if it ends up being accretive, right? So the question is really, what are you doing with the money? If you're diluting to pay out executives, then that's really not helping shareholders. But if you're paying, you're diluting, get that money and reinvesting it in, you know, more machines, more facilities, etc. You know, that's really not necessarily bad. And as you said, you know, if they can reinvest in things that are even, you know, sort of a step function improvement for the business, then yes, that's a money very, very well spent. All right. So I have a line here for, you know, what is the estimate of total network hash rate? This one is a wild card. Who knows on this one? I'm going to go through a couple scenarios for whoever sticks around this long to sort of look at how do things change for Marathon as the overall Bitcoin hash rate changes, right? Because they are not in control. They can control their own hash rate, but, you know, who knows if every other Bitcoin miner also expands and we start to get, you know, sovereign nations that want to mine Bitcoin as well, and they have sufficient, you know, capacity. You don't really know what's going to happen to the network hash rate. I will talk about this again in a couple scenarios. For now, for my initial model, this is just held constant at, you know, about 550, exahashes per second for the overall network. So given all those, I can estimate, you know, how many blocks in the quarter is Marathon gonna mine. You know, then we know the block reward, you know, 6.25 just for this quarter, and then it drops to 3.125 for, you know, every other quarter over the next, you know, 4 years. My model doesn't go out 4 years, only goes out 2 years. But then we have the average fees per block. This is a wild card. I actually don't know what these have been very recently. I know in the end of Q4 they were higher and tended to be, you know, 1 Bitcoin or more per block on average. You know, this is going to fluctuate, and who knows what it's going to be. I think, you know, again, as Bitcoin itself gains adoption, these fees are going to go up, just because there's more demand for block space, so the fees are going to increase. All right, now from that we can see how many Bitcoins do they mine, and then we come down to sort of model for the earnings. So obviously the most important piece of their revenue is what is the Bitcoin price, because then you just multiply this out, you get their actual revenue from mine. Then we have their cost of revenue from energy and their cost of revenue from hosting. And so this actually, you know, I have a model. I use the numbers that they gave out on the most recent earnings call and some, you know, extrapolations from their prior earnings reports. I'm not going to go through in too much detail, but basically, you know, as their percent of their fleet that they self-operate goes up, these, you know, costs on a per hash rate basis go down. Because they are able to operate their facilities more efficiently than when they are at a hosted facility, because that person who's hosting it is going to capture a margin on whatever they charge them. So that is that. For their G&A costs, I really had no clue what to put for here. It's unpredictable lots of times in terms of how our G&A costs are going to grow. What I did was I just started at $40 million in Q1, increased it by $2 million per quarter every quarter throughout this time frame. So it goes up from 40 million in Q1, which I think is roughly what they did in Q4 of last year, and just increase it. So by the end of 2025, they're at $54 million in G&A. So that's, I don't know what this is going to be. It's really hard to predict these things. It could be flat. It could actually go down. If they really wanted to be great stewards of capital, sometimes you can see these companies actually cut their G&A expenses over time. But I think all of their R&D goes into this G&A budget as well. So I don't expect this to go down over time. I expect it to go up. For some of those things like Anduro and Slipstream, I really think those are coming out of this line item, because they don't have a separate R&D line item on their in their reporting. Let me actually bring that up real quick, so you can see this is their results of operations. They have their that's not what I'm looking for. There's the one that I want. There we go. Statements of comprehensive income. So they have the revenue. I know this looks similar. I just want to get the official one. They have their revenues here, and then their cost of revenues. They have those two things that I just mentioned. Well, they also have depreciation, amortization. In my model, I'm only looking at EBITDA, so I don't care about depreciation, amortization. But then you look at their other costs, and they have G&A, and that's basically it. They also have their fluctuations in their actual digital assets. I'm not worried about that. But just their G&A costs, that's really the only other line item here that goes all the way down to their operating expenses. So again, I think all of that stuff that I would normally see split out into an R&D line is not for Marathon. So just a note that it actually goes under their G&A. Sorry, let me see comments. DEFCON 2 says, yes, in theory, miners will survive off the fees alone, but a miner can protect itself with a zero cost energy. Fees alone, eventually long term. Yeah, 100%. Totally agree. So in my model here, just going to subtract off all these expenses to get to their EBITDA each quarter. And then they have a little bit of interest expense. It's pretty small at the moment, but you do have to include it. And then I have this line for EBITDA, right? So it's EBITDA, but actually I'm subtracting off the interest expense. Just to give an idea of, what does their profitability look like without the deductions, the amortization, and, forgetting about taxes, So looking at this right now, that's their sort of core profitability metric that I'm looking at here. Then I go down and I want to look at what is their CapEx, right? Because I just said, they're going from roughly 25 at the end of 2023, 25 exahashes per second, to roughly 50 exahashes per second by the end of 2025. And so that's going to require a lot of CapEx. They look at this and I say, what do they need in terms of machines? And so I'm looking at adding how much hash rate they're adding per quarter. I kind of had just a rough guess here for each individual quarter. It's not exactly smooth. I just kind of put in some numbers arbitrarily. You could muck with them a bit, although it doesn't make that much of a difference. I tried to weight it a little bit more towards the end of this year and a little bit more towards more in next year, right? As these, because they sort of said that there's two factors here, right? Number one is they need the space in that facility they just acquired. They need those existing hosting leases to actually expire before they can start to put machines in there. And then they also need Auradine to actually produce these machines. And I don't know that those are available quite yet. I think they said they're going to start shipping in Q2 or maybe Q3, if I recall correctly. And so, they're not going to be able to get all of these installed immediately. It's going to take some lag time because of those two factors. That's why there's more capacity additions in by the end of this year and into next year than there are sort of front load. It's not quite smooth over this time period. So, but this model does actually get you to 50 exahashes per second at the end of 2025. I add up, I calculate how much are they going to have to spend for machines. I used a number of $15 per terahash in terms of their actual cost for these. So this is, I think, is fairly reasonable. And, it comes out to this amount of CapEx per quarter. I also put in some model for facilities. And because of this additional, 330 megawatts of power that they have in terms of the spare capacity eventually once those leases run out at that facility they just acquired. They actually don't need to acquire a whole bunch of facilities in order to put all these machines in. So this is, their cost for acquiring facilities is pretty low until they get sort of middle end of 2025. So I did model it out and said sooner or later they're gonna have to buy this. I used a cost, I think, of I don't remember what cost I put in here. I think $500,000 per megawatt, and I think I got that number just from looking at how much their prior acquisition cost them. It was about $179 million for 390 megawatts. So just to divide that out, figure they can make another acquisition that's at that same cost per megawatt, and that's how I calculate this out. And so eventually they're going to need to acquire more facilities in order to actually put in 50 exahash per second. Maybe there's a bit of an asterisk there, and that might be if some of their older machines they actually dispose of and put in more efficient machines, they might be able to pack in more hash rate for the same amount of megawatts that they already have. It's kind of hard to say, but again, I also square this way with what I estimated their efficiency of their fleet is at that point. And so this kind of, the math that I put in here does, I think, make sense for the model that I built. Again, different scenarios could play out, but that's kind of how I view it. It's plausible. So hopefully it's in the ballpark. All of that CapEx, comes down here. Now the question is, how do they fund that CapEx? Clearly they're making, I did this EBITDA in terms of, dollars, but really we're looking at, operations. They're getting Bitcoin, right? That's what they're actually bringing in. So then they have some options, right? Do they actually sell that Bitcoin to fund their operations? Or do they sell the Bitcoin to, fund their CapEx? And so my model here makes a couple assumptions. I'm assuming, number one, they are going to sell their Bitcoin to fund their operations, right? So to the degree, to where they're actually getting, $210 million worth of Bitcoin revenue in Q1, or let me do Q2 because it's a little bit cleaner. They get $210 million in terms of revenue from mining Bitcoin, and they actually have all these costs that come out to about $150 million. I assume they're going to sell $150 million worth of Bitcoin, and then also sell some Bitcoin to actually pay for the interest expense, and then the remainder, $55 million worth of Bitcoin, that they are going to retain that amount, right? So that means they would retain, about 738 Bitcoin there. Alternatively, again, just to be clear, they could decide to not sell any of that Bitcoin, hold that on the balance sheet, and instead, dilute and sell more shares in order to get the money, at least for a period of time, right? And that might actually work out better for them if they thought that Bitcoin was going to appreciate in price in short order, and so it would be better to actually just hold the Bitcoin rather than sell it immediately. But my model right here is assuming that they're actually going to sell the Bitcoin in order to fund their operations, but I assume they are going to dilute in order to fund their CapEx. And I think this is roughly what they've said their general principle is, although they've sort of danced around this and done different things over time, from what I saw. Sorry, let me see what DEFCON 2 is saying. It's unclear. They do sell, but not sure if it covers all operating costs. Right now, Bitcoin is on run, so I guess selling the Bitcoin at this time doesn't make sense. So it's interesting, right? Because I'm going to talk about this just for a moment, then I'll move on to some of the rest of my model and the conclusions from it. It is interesting because, yes, Bitcoin is going up, but at the same time, they don't reap the benefits of being a low-cost producer if Bitcoin continues to go up, right? Because let's say hypothetically everybody was profitable with the current block reward, 6.25 Bitcoin, and a $40,000 Bitcoin. If Bitcoin jumps to $80,000, now all of a sudden they can happily accept half of the block rewards. Everybody can, right? Because Bitcoin price doubles, having the block reward doesn't actually mean anybody goes out of business, right? And so now all of a sudden, there's a little bit of game theory here where if Marathon can do things to actually push the price of Bitcoin down at some point, that may be more advantageous for them if it can drive some competitors out of business, because it lowers the overall network hash rate. And it's not just them, right? This is true for every Bitcoin miner. But, they all have to sort of take their own make their own strategy and figure out what they're going to do. If everybody wants to dump their Bitcoin, that's going to, put some downward pressure on the price. If no one dumps their Bitcoin, they all try to hold it, then yes, Bitcoin price is going to go up. But what's going to happen sooner or later, as they're diluting their stock, and what might happen, they're exposing themselves to a heck of a lot of risk. So like everybody has their own thoughts, their own views on this, and their own plans on how they're going to deal with this, and what risks they're willing to take and what they're not. So I think it's pretty interesting. Sorry, I know that was a bit of a tangent, but if I look at this and I say again, make the assumptions that I made, and these are variables. I could go through a couple scenarios in a moment. For again, anybody who's sticking around really wants to go deep on this. If they actually then dilute in order to, so that's what this line is here. How much cash do they raise via dilution? And then what is their share price at that sale? Which I could probably format that as a number here, so you can $20 per share. And again, this is pessimistic. Then how many more shares would they be issuing in terms of millions? Lots of shares here. 3 million, 1.67 million per quarter, etc. And then if there was any remainder, again, right now I'm assuming they actually fund all their capex here. But if there's in a remainder model, I can put into my model and say, well, let's sell some of the Bitcoin to actually fund the capex. But then if I look at all of this and I say, how much do they actually retain at the end of this? And that's this number down here, right? So if they sell, let's say just hypothetically, right now I have it modeled as they would retain, 2,700 Bitcoin, 2,800 Bitcoin. If instead they actually sold none of their Bitcoin and they diluted a lot more to pay for their operations, they could retain even more Bitcoin for the quarter. But for now, this is what it looks like. Project that out over time, and this is kind of how things look for them. So they grow over time. I'll just go through their earnings real quick. So even as the block rewards drop, I have the price of Bitcoin going up. And again, you could have your own assumptions here on what you think the price of Bitcoin is going to do. I have it going up, 75 in Q2 on average, 90 in Q3, and $100,000 into Q4, and then staying at $100,000 throughout 2025. Again, Bitcoin could run way past this. It might never reach 100,000. I have no idea. I have my opinion, but I have no actual idea. This, I'm hoping, is in the ballpark or conservative, right? I actually think I'm hoping this is a conservative model in terms of, what we could see for the, Bitcoin market over the next year and a half, to stay at only 100,000, which would be like a 20 or 30% upside from now, and then sort of being flat after that. Just so we can have an idea of what does this mean for Marathon. Because, clearly if Bitcoin goes higher and higher and higher, that I think is going to be wildly, good for Marathon. So I wanted to have a model here which says, if Bitcoin doesn't go to the moon, what is a decent valuation for Marathon? Because if Bitcoin goes to the moon, if Bitcoin goes to $1 million for Bitcoin in 2025, then, being a large Bitcoin miner is going to be a wildly profitable operation no matter what they do. So again, with a more conservative Bitcoin price forecast, this is kind of how things work out. They're still profitable every quarter, at least if they're selling their Bitcoin that they're mining enough to fund their operations. And their EBITDA looks to be around, it grows as their hash rate grows from lowest of $60 million in Q2 all the way up to almost $300 million in Q1 of 2026. And so if I use all of those assumptions and I look at sort of what does a valuation look like for 2026, I did two different ways to value the company. And in this model, they have, with those assumptions, you get to final shares outstanding of about 293 million shares. Currently one note I will put here, this is their actual share count is probably going to end up being higher, but their actual cash spend is going to end up being lower because I'm not putting stock-based compensation here. I just said all the G&A is cash costs, not stock-based compensation. So again, these numbers are going to be off a little bit, but I think some of that higher stock-based compensation, so higher share count outstanding, is going to be offset by lower cash costs if they actually are doing stock-based compensation. So this is my, roughly what my model would predict here. And so you look at that, and by the end of, or by end of 2025, beginning of 2026, you're getting to, roughly a balance sheet where if you have 100,000 Bitcoin, you have your balance sheet value because of all the Bitcoin that they're able to retain of about $3 billion. And you're looking at, sort of a 2026 forward EBITDA of, $1.2 billion. And so if you do sort of an enterprise value to EBITDA valuation for the stock, depending on what multiple you want to give it, and I think, somewhere closer to like, the 5 to 9 range is pretty conservative. I think 3 would be very low. 12 to 15 is still even reasonable. I just say some of these lower multiples are what I would be more willing to believe, because Bitcoin mining stocks are just not loved by the market in general. There's a lot of risks with them. And so I think, having a view of, hey, if the market is only valuing at a 7, enterprise value EBITDA, this is what the stock is going to look like, gives you a reasonable idea. So, but again, I think 15 is sort of a standard multiple you expect. 12 to 15 is a pretty standard range. So if you look at those, you're looking at, $58, $70 stock by the end of, 2025 at $100,000 Bitcoin. And again, that, there's so many assumptions baked in here, but it does give you a range of possible outcomes. I also did looking at what if I try to calculate their depreciation in terms of how much are they going to have to pay to replace these machines. And I think their depreciation pretty soon is going to come to be pretty large, right? They're going to have to replace these machines every 3 or 4 years. Figure if they spend, this is my calculation, but if I figure it's just shy of $200 million per year, that means that their actual earnings, if I'm looking at some sort of a GAAP earnings, ignoring the fluctuations in the price of Bitcoin, because that does flow through to GAAP earnings nowadays. If I ignore those fluctuations, their GAAP earnings would be just shy of $1 billion. Again, looking at sort of an enterprise value to earnings valuation gets you to a very similar range, which shouldn't surprise you. Maybe it's slightly lower for some of these lower multiples here. I guess slightly higher. It's kind of a mixed because I had different multiples here. But again, you're looking at where you normally expect to see somewhere between the 10 to 20 range. A 40 to 77, 44 to $77 stock in, per those valuation models at the end of 2025, beginning of 2026. So that I think is pretty interesting. Now, let's go back and, I think if I was going to say, again, sort of looked at, well, let me see for comments. Sorry. Mara has a lot of access to cash. They maxed out their ATM with $750 million in record time. So yeah, dilution sucks. Many of the other miners can't do that, and they sure wish they could. But ultimately, like I said, zero cost of mining or bust. Dilution can't go on forever. 100%. Totally agree. And yeah, and they even filed a new one for, I think, 1.5 billion. And partly they sort of called that out because they said, between that 1.5 billion that they could, use their ATM for their at the money offering, at the market. I always say the wrong thing. At the market offering to dilute, and also to, the Bitcoin that they have on their balance sheet and the cash they have on the balance sheet. That's $2.5 billion. They've kind of alluded to the fact that they see some other companies are going to start to struggle at some point, maybe, and that they want to have a bunch of cash, a bunch of liquidity to be able to take advantage of whatever happens. And when I look at the decisions that management has made to date, I think they've done a good job. So, I at the moment, I'm willing to actually trust in this management team to do a good job, to make good decisions in terms of when should they dilute and when should they not. So that I think is at least, it doesn't scare me that they did that. Doesn't give me warm fuzzies either, that they filed for $1.5 billion of dilution. But again, I think it hasn't always happened. It hasn't already happened. And the question is really, what are they going to do with that money right now? At what price are they going to dilute? Because the other thing is they may have that sitting out there just in case if Bitcoin shoots up really fast. And let's say their stock, let's say hypothetically, 2 months from now, Bitcoin shoots up and Bitcoin is at $150,000. Marathon stock is at, $60 per share. And they say, we could dilute now at 1/3 of the amount of share dilution that we would have had, just 2 months ago. Let's go ahead and do it. It's $60 per share, not $20 per share. Let's go ahead and just do it. It's not going to hurt us to have the cash in the bank. We've got some, and if Bitcoin goes up even further, you know, what was the harm? We diluted at a pretty good valuation, and if Bitcoin goes down, we look like geniuses because now we got a bunch of cash on hand. As other companies start to have issues, we can make a bunch of acquisitions and just really, make some great moves. So, sorry, DEFCON 2 says, right now the sentiment is risk off, no easy money, but perhaps if the Fed eases on the rates, then the minor stocks will run, and Mara the most, in my opinion. Mara wants to take advantage, but I hear you rattle me to the 1.5 billion ATM. To take advantage of what may come post having acquisitions, buying assets, etc. Yep, 100%. And again, I think do you trust management? That's really almost always when management says we want to dilute. That's what it comes down to. I think management has done a pretty good job so far. They've done a lot of work to diversify the business, to set themselves up for good growth, and they are going to have to acquire another facility at some point. So, I mean, I think they have the cash on hand that they would need for that, but really, they might be looking for even, they might have even larger ambitions. 50 exahashes by the end of 2025. Maybe they, have some opportunities as things go on to really grow even faster than that. And, it's also a little bit interesting because as you look at this total network hash rate, it's one thing if they're able to just build it themselves. If they were able to acquire it from someone else, it's sort of a double whammy because you are increasing your own hash rate, but you're taking away from someone else, right? If you're acquiring someone else's hash rate, then the overall network hash rate is not increasing. Even though if you just go out and build your own capacity, you are building your own capacity, but also increasing the overall network hash rate. And so I think that's kind of an interesting piece here where, sometimes in this particular space, because of the fixed amount of Bitcoin that there is to go around, acquisitions are potentially even more attractive than just building your own capacity sometimes, which is a very, very interesting dynamic. There's a lot of interesting dynamics in Bitcoin. All right, so if I go through another scenario, let's say the Bitcoin network hash rate actually goes up, by 50 exahashes per second per quarter globally. And so let's say, again, meaning that even though Marathon is growing, the overall network is also growing. So if I do this, add on 50, this does change the story a little bit to where by the end of 2025, the first quarter of 2026, it changes quite a bit. Instead of actually being able to mine, well, let me see. So before they were able to mine about 1,200 blocks in per quarter. If the network hash rate grows, from 550 to 950, which is what's that, a 60-70% increase. Now all of a sudden they're only mining about 682 blocks in that quarter, and so again their revenues go down quite a bit, and their EBITDA drops from, I think what I said earlier, of almost $300 million, almost $300 million to $90 million, 87 even, and you subtract off the interest expense, and now you're only at 84. And that gets you to some outcomes from the stock price that are significantly lower. So I think that's one thing to really be aware of, is if the overall network hash rate continues to grow and grow and grow because of the nature of Bitcoin, Marathon's growth is not going to, doubling their hash rate is not going to double their Bitcoin block rewards, right? Even once the block reward is held constant, just because they're not going to be able to mine as many blocks. That's very, very much an unknown, and is a risk to every Bitcoin miner. Now, on the flip side, let's say Bitcoin hash rate is going up, but in tandem, the price of Bitcoin continues going up. Let's go through sort of a 125,000. Let's say it goes by 25,000 per quarter, right? In 2025, 21 plus 25,000. So if we did this, now all of a sudden Bitcoin's price rise increase is dominating even their loss of ability to mine blocks, right? So even though they are mining less blocks, as I said, only 682 in the quarter rather than the 1,200 or so, the increase in Bitcoin price, if it doubles from 125, or roughly doubles from 125 the beginning of 2025 to 225 by the end of 2025, now all of a sudden the revenues double, their EBITDA goes up to $400 million in the quarter. So now, again, by the same valuation model, now you're looking at from again, for the range of multiples we saw here, somewhere between 30 to, 100 to even $130 per share, and even by the earnings model, you're looking at, 35 to $140 per share. And so this is really just calling it out to say there are so many unknowns to where, plausible changes in some of these factors make humongous differences in the valuation. So this really gets to, kind of my original model where I was trying to give what I think are realistic, but on the more conservative side in terms of valuation. But clearly if Bitcoin continues going up, Marathon is going to benefit massively, and that will probably, they will probably, because they're already in the position of being a fairly large miner, and they have some potential upside from some of these other services from the Slipstream and Anduro, that they are in a position to benefit as Bitcoin price rises, and leverage that immediately and leverage the balance sheet immediately to really grow their hash rate as quickly as possible to maintain and even grow their share of overall hash rate, and sort of just capture some revenue. So again, I think there's so many unknowns that but Marathon, if I'm looking at all the miners, they've put themselves in the best position they possibly can in terms of having sort of lots and lots of irons in the fire to ways to win here, I guess I would say. Yes, Defcon 2 says, yes, so many unknowns. Great job though with your modeling. Thanks. Yeah, that was it. That's what I had. I mean, clearly, I've got the whole thing modeled out here, and I could go through more scenarios if people really wanted to, but I'm gonna end it there. That was I think my longest stream ever at an hour and 15 minutes here. I appreciate you sticking around. I think there's a couple other folks on the stream. I don't know if anybody else has questions or comments. I'm happy to stick around for a couple minutes. Just in closing, I would say, I think at the, what's it, $25 per share that is now, I think it's, I intend to purchase some. Let me put it that way. I intend to take a long position. Probably not a huge position because, again, there are so many unknowns. Let me go through another scenario here where, let's say Bitcoin stops at 90,000. This I think is unlikely, but if it stopped at 90,000 and the overall network hash rate did grow, let's say there are people who are less profit motivated, some sovereigns who want to just grow and have 5% of overall network hash rate to make sure that they can actually mine some blocks themselves and not be censored by anybody. That would get you to a point where Bitcoin, or where Marathon here is really only looking at again, what's that, $220 million per year in terms of EBITDA, gets you to some outcomes for the stock that are fair value, I think, is probably at or below what it is today. Clearly below what it is today. If I'm looking at just this range of multiples here, this range of multiples here, it's a tough game, right? Where there are. So I guess this is me saying I don't want to make it too rosy. Right? I don't want to say that, hey, Marathon is a position where no matter what they do, they're going to be worth more in 2 years from now. They very well could be. If Bitcoin price does not go up, they do function very much like a leverage play on Bitcoin. And so if Bitcoin doesn't go up, there's not a whole lot of upside in the stock. Now, I personally don't think that's likely. I think even just looking at the recent events, this would seem ridiculous to me from where I'm standing now that Bitcoin would not go above $90,000, over the next 2 years, but it's possible. No one can predict the future. And so there certainly is risk to the company. I would say that short of a significant crash in Bitcoin, Marathon has put themselves in a position to really be in that lower cost, as I say, the lower quartile in terms of cost to produce Bitcoin. So I think in terms of the risks across all the miners, they are on the lower side. And also because they have the, more, and then this goes hand in hand with being a lower cost producer. They have one of the more efficient fleets out there right now, so as other folks that have less efficient fleets, if Bitcoin price doesn't go up and the block rewards get cut in half and other people are looking at revenue that is, much, much lower than it used to be, and they start to become, not profitable, I think that is, that will benefit them. And I think they've minimized their risk of having to dilute or facing bankruptcy. But again, not diluting and not going bankrupt doesn't necessarily mean that you are going to be in a position to actually be worth more in the future. So there are risks. There's also a lot. There's risks as a downside, but there's definitely a lot of potential to the upside in terms of different events that could unfold. And hopefully, I've given you some ideas to think about here. So, DEFCON 2 says yes, there's risks, not all is rosy. Yeah, absolutely. So I think if you really want to summarize the whole thing here, I think they've done a good job. But in the end, they end up being sort of a leverage play on Bitcoin. Where if Bitcoin does not do well, they're not going to do well. If Bitcoin does well, they are going to do very, very, very well. So that's, I think, the bottom line here, which is true for most of miners. But Marathon has done the best they can to actually minimize the downside risks there. So DEFCON 2 says, but yes, I think Marathon is focused on reaching zero cost more than any other miner, and that to me is so crucial. I hope they achieve it. 100% agree. All right. I am going to hop off now. I will give my normal 30-second spiel just in case there's any other questions or comments on the chat. I'll give you just a moment. For anybody still watching, I do these streams. I try to get one in every Sunday, usually in the afternoon, sometimes the evening, like I was today, in Eastern U.S. time. I usually talk about stocks or Bitcoin of some sort. Do them live here, so happy to talk about whatever. Probably, if anybody cares, the next couple of weeks I'm probably going to be focused on. I think Next Decade is going to release their earnings pretty soon, and I'll probably cover them, and also Enviva. I don't have I've still gotten a lot of comments on my Enviva videos, ticker EVA. I'm not invested. I think there's a ridiculously risky stock right now, but people apparently like to gamble on it. And so I will probably cover them in the next week or two as well, as something material is announced. Either they decide to go into bankruptcy, or they are able to come up with some deal, or who knows what. But I will be talking about that if there's anything material that gets announced with that. So all right, I do not see anything else in the chat. I'm going to hop off. Thank you all for watching. DEFCON 2 says, thanks, Dustin, for the video. You are welcome. Thank you for the kind words. Thanks for all the information in the chat. Really appreciate it. So, all right.